for joining us for this month's Market Update. I'm here today with Chris Trevillyan, Director of Investment Strategy at Frontier. Hi there, Chris.
Hi, Wayne.
Always good to talk about equity markets, and certainly they were pretty strong in October, weren't they?
Yes, they were. So this chart here shows the performance of global equity markets since the pandemic impacted early last year. And you can see there has been some short periods where the performance has been negative, and that's what did happen in September. But as you can also see, there is this trend of continued strong performance since the initial downturn from the pandemic. Now, the positive performance in October was driven by positive earnings reporting results. And in particular, that again was in US equities and the technology sector, which performed particularly strongly. You can see on the chart there, the orange line is for Australian equities, which has still been positive, but not as strong as global equities. So in the month of October, Australian equities produced a small positive return. And that was driven by resources stocks, which were actually negative as the iron ore price continued to fall. And that was driven by Chinese economic slowdown, and in particular, a contraction in the construction activity in the property market, directly linking through to the iron ore price.
So last month, Chris, we spent a little bit of time talking about energy markets. Still plenty happening there. What's the latest news?
Yes, very volatile and a lot of movement in energy markets. So this chart here shows the movement of a number of energy commodity prices over the last 12 months. And the orange line there is for the oil price. The oil price rose strongly again in October, and the price of oil now has roughly doubled over the last 12 months. The chart also shows the movement of the price of natural gas and coal, and as you can also see, very large increases in those energy commodity prices over the last 12 months. So what's driving the energy market prices? It is a sharp increase in demand as the economies are opening up after the restrictions through COVID. And that very strong demand being impacted by some supply chain constraints to meet that demand. We're specifically seeing in Europe, for example, with the natural gas market, there is potentially some linkage to geopolitical issues with Russia. And in China, we're seeing coal supply constraints actually causing some electricity blackouts in China. And that's actually contributed also to some of the slowdown in manufacturing activity in China. Now, the expectation is that this is going to be a temporary spike in the energy prices. And even in sort of recent days, we have seen some of those prices come off their peaks. And if we look at the futures market, the pricing there is that these prices will come off going forward. But this is a particularly key thing that's impacting markets and continue to be monitored closely going in the near term.
So energy always in the news, and particularly in recent weeks. Another topic that gets a lot of media attention, of course, is the outlook for interest rates. That's been getting a lot of attention as well, Chris. Bring us up to date there, please.
Yes, somewhat linked to the energy markets. The supply chain constraints that we're seeing, the increased prices of energy has flown through to an increase in inflation. And the high inflation near term has caused markets to bring forward their expectations of when interest rates will rise. So this chart here that we're showing shows the futures market in Australia for the RBA official interest rate going forward. At the start of the year, there was very little expectation of interest rate rises next year. The yellow line on that chart shows the futures pricing at the end of September, and you can see at that point there was just a small increase in interest rates expected next year. But the orange line, which is updated to the end of October, shows that the futures market is now pricing in a significant increase in interest rates next year. So it's pricing in a number of interest rate rises in 2022, and that by the end of the year, the official interest rate will be above 1%. So that's brought forward that very significantly over the month. Now, the RBA subsequently, at its meeting in early November, did announce that it was no longer targeting the Australian government bond yield in April 2024. And so that contributed to the bond yields rising over the month. But the RBA was also very clear that its expectation was still that it would not be raising rates until at least 2024. So that's quite different to what the market is now pricing in. We're seeing a similar thematics overseas as well, where the increase in inflation is leading the market to bring forward its expectations of rate rises. But central banks are still making it clear that their view is that any interest rate rises are going to be gradual. So this is a particularly interesting thing to watch over the next little period. There's quite a big disconnect between what the market expectations are and what central banks say that they're going to do in regards to raising interest rates.
So yes, some interesting differences in signalling there. We look forward to watching how that unfolds with you over the coming months. Thanks for insights, Chris, and thanks for watching this month's Market Update.